bankers, welcome to Oliveboard. Good evening everyone. I hope you all are doing well. So this is the video of Bank Financial Management Module A, International Banking Risk in Foreign Trade, Role of ECGC, and the MCQs are here related to Macmillan book. We will discuss every MCQ with the concepts related to that MCQ. So let's get started with our first question. So our first question is here. A risk is related to illness which does not affect the human life, related to events which do not affect the profits of the organization, related to unplanned events with financial consequences resulting in loss, and a certain event where outcome is known. We know that what is the meaning of risk here. See, if we talk about risk is basically possibility of an event that could negatively impact on companies' finances, reputation, or sustainability. It can include the chance of financial loss or other damage. Risk means basically uncertainty. Okay, that is risk, uncertainty. And if we talk about in the options, related to unplanned event with financial consequences resulting in loss, because risk is directly related to loss, so we can say that a risk is related to unplanned event, obviously, with financial consequences resulting in loss. So here the option C is correct. Now moving to the next one. Second question is here, country risk is when the. So what is the meaning of country risk? Country risk primarily refers to the risk that a buyer or borrower may be unable or unwilling to honor their commitments, or we can say unwilling to honor their commitments due to government actions or political instability. If we talk about country risk is the when buyer or borrower is forbidden by the government to honor its commitment, and the other options are incorrect because, see, if we talk about liquidity risk here, liquidity risk pertains to the inability to meet short-term financial obligations. Settlement of risk involves issues arising from the timing or mismatch of funds during transactions. But interest rate risk typically refers to the potential for changes in interest rate to affect the value of investment, not necessarily linked to favorable movements. So here the correct answer is country risk is the buyer or borrower is forbidden by the government to honor his commitment. Country risk is critical considerations for investors and businesses operating in international market. It encompasses various factors that can affect the financial performance of investment and requires careful assessment and management to minimize potential risk. That is country risk. If we talk about here liquidity risk. Liquidity risk basically is that risk where a financial institution or individual may not be able to meet its short-term financial obligations due to a lack of liquid assets. In other words, it is the risk that an entity may not be able to convert its assets into cash quickly enough to meet its liabilities. That is liquidity risk. Then what is the meaning of operational risk and why operational risk does not occur if, see, operational risk occurs due to disruptions, and disruptions where in internal processes. Okay, internal processes, peoples or systems. Here, only delay in payment by the buyers does not directly disrupt the internal operations of the company. And here the other options are given. First is strike at the port. This option would directly impact the company's operation as it would disrupt the loading and unloading of goods and leading to delays in shipment and potential financial losses. Okay. Second option is here non-loading of goods. See, non-loading of goods on the desired ship due to rains. We can say that here this scenario would also affect the company's operations as it would delay the shipment of goods, potentially leading to missed deadlines, increased cost and customer dissatisfaction. Then delay in supplies by sub-suppliers. This option would disrupt the company's production process as it would delay the availability of necessary components or materials. This could lead to production delays, increased cost and potentially missed orders. While these options all are representing potential disruptions to the company's operations, they are not considered operational risk, because they primarily involve external factors beyond the direct control of the company's internal processes, people, or systems. Operational risks typically arise from the internal issues or failures with the company's own operation. So here the correct answer is delay in payments by the buyers. Operational risk is the risk of loss resulting from inadequate or failed internal processes, systems and people, or from external events. It is a type of risk that arises from the day-to-day operations of the organization and can affect its ability to achieve its strategic objectives. Now here fourth question is a standard ECGC policies do not cover. Standard ECGC policies. See, if we talk about standard ECGC policies, they are generally do not cover exchange fluctuation risk. Why? This means that if the value of the foreign currency in which the export proceeds are received and decreases compared to the compares to the Indian rupee, the exporter may not be fully compensated for the loss. So risk due to insolvency of the buyer, here this is a risk that ECGC policies typically cover. If the buyer becomes insolvent and unable to pay for the goods, the exporter may be eligible for compensation under the policy. And if risk due to default by shipping company, here this is also a risk that ECGC policies may cover depending on the specific terms and conditions here of the policy. If the shipping company fails to deliver the goods, or if the goods are damaged during transportation, the exporter may be able to file a claim. Now, fourth option, risk due to new licensing imposed by buyer's country. Here, this is another risk that ECGC policies may cover. If the buyer countries imposes new licensing requirements for the exporter to sell their goods, the exporter may be eligible for compensation. It is also important here to note that specific coverage provided by ECGC policies can vary. So it always depends on the amendments or any other changes if occurs. So a standard ECGC policies do not cover exchange fluctuation risk. Now, ECGC, we know that Export Credit Guarantee Corporation of India. Standard policy, also known as SCR, is a whole turnover policy that provides insurance of an exporter regular shipments with a credit period of 180 days. It designs to cover risk for exporters with an annual turnover of more than 50 lakhs. Now, exchange fluctuation risk of ECGC covers C. While ECGC does provide some coverage for exchange fluctuation risks, it is important to note that coverage is limited. Okay. The policy typically covers exchange fluctuations that exceed 2% and up to 35% of the contract value. So if we talk about here, the correct answer is our option D, that is covers exchange fluctuation above 2% and up to 35% only. This is the correct answer here. Okay. And we know that exchange fluctuation rate is also known as foreign exchange forex risk or currency risk, is the possibility that a company financial performance will be affected by currency fluctuation. And we know that exchange rates are fluctuated in every 4 seconds. This risk can occur when a company's transactions are denominated in a currency other than its base currency. Okay. Now, next question is here. General policies of ECGC do not cover. General policies of ECGC. Okay. See, ECGC covers various risks related to exports. It generally does not cover commercial disputes between the buyer and seller. These disputes often involve contractual disagreements or quality issues that are not directly related to the buyer's financial ability to pay. Okay. Now, insolvency of the buyer. Here we can say that ECGC policies typically covers the risk and protecting exporters from losses due to buyer's inability to pay. Restrictions imposed by buyer's country. Here ECGC may cover risk related to government restrictions that prevent the buyer from paying for the goods, such as import bans or currency controls, default by buyers to pay for goods already accepted. This is a risk that ECGC policies generally cover, protecting exporters from losses due to buyers' failure to pay despite having accepted the goods. So here the correct answer is general policies of ECGC do not cover commercial disputes between the buyers and sellers. So that means option A is correct here. ECGC, we know that Export Credit Guarantee Corporation of India Limited, a government-owned company that provides credit insurance to Indian exporters. ECGC was established in 1957 to promote exports by helping exports manage the risk associated with international trade. Okay. Now, most important question is this, that is the guarantees given by ECGC to cover loss on advances for incentives receivable by exporters at a pre-shipment stage is called. Okay. See, here the guarantees given by ECGC to cover loss on advances for incentive receivable by exporters at pre-shipment stage is called packing credit guarantee. What do you mean by packing credit guarantee? Packing credit guarantee provides financial assistance to exporters to meet the expenses incurred during the manufacturing or processing of goods for export. This includes expenses such as raw material, wages, overhead cost. In essence, it helps exporters bridge the gap between the time they start production and the time they receive payment for their export. Also here the option is given post shipment export credit guarantee. This guarantee basically covers the risk of non-payment by foreign buyers after the goods have been shipped. Okay. Then packing credit guarantee we already discussed. Export production finance. Export production finance, we can say this is a type of financing provided by banks or financial institutions basically for exporting or to support the production of export goods for export, and it can cover various expenses related to production such as raw material, labor, overhead cost, these things. And export finance guarantee, this is a broader term that can be encompass various types of guarantees or insurance provided to exporters to mitigate risk associated with export transactions, and it may include both pre-shipment and post-shipment guarantees. So the here correct answer is packing credit guarantee. Now our next question, that is credit guarantee are on the risk sharing basis, means that here see, when an exporter obtains a credit guarantee from an insurance company, it is essentially to form a risk-sharing agreement, a form of risk-sharing agreement, a form of agreement between seller, that is basically exporter, and the financer, that is basically usually a bank. The financer provides a loan to the exporter to cover the protection or purchase of goods for export. In exchange for this loan, the exporter agrees to pay a premium to the insurance company. So here we can say that the correct answer is the seller shares the risk with the financer. Okay. So I hope you like this video, and in this video we learn the things related to ECGC policies, related to risk in foreign trade, and also the role of ECGC. I hope you like this video. If you like this video, please like the video, comment this on this video, and also you can comment your feedback in the comment section, and subscribe to this channel. So we will meet in our next lecture, next video lecture, which is already related to role of Exim Bank, Reserve Bank of India, exchange control in India, FEMA, FEDI and others. We will discuss the MCQs related to your Unit 8 in Module A. Thank you for watching. Take care.